Hey, how's it going? This is Nick Nelson. I'm a CCIM here in Austin, Texas, partner at Longbow Real Estate Group. My specialization is investment sales, and wanted to talk to you guys a little bit about discounted cash flow analysis, underwriting, mainly from a perspective of an investor. You got to know what you're getting. So I put together a case study that's based off a couple deals that I did, and I changed some stuff up so nobody could really figure out which deals they were, so my clients don't get mad at me. So I'm up here on a Saturday. I'm not dressed up for you guys. Hopefully that's okay. All right, so I'm going to dig in. All right, so the investors communicated their acquisition criteria. So what they've said is they'd like their investment strategy to be core plus. They like a 15% leveraged IRR, minimum cap of 6.5%. One thing to note is, it's not on the sheet, but the debt financing piece. So this investor's probably going to get high 4s, low 5s on their interest rate. And one of the metrics that investors like to use is the spread between their cap rate and the interest rate for the loan. So that spread, ideally, you'd like to see 150 basis points, just as a side note. So this person wants office or retail. They've got $1.5 million to place, and they've said the geography that they'd like to work within is in Austin, NSA. All right, so for the purposes of this video, we are just going to assume that we've skipped the marketing process and we've got this deal under contract at a 6.75% cap rate. Here's the acquisition price right here, 4.1. Building size, 10,000 square feet, puts us at $412 a foot. You get the tenant mix, national restaurant. You can read through some of this stuff. So good location, strong traffic, synergistic tenants with nearby shopping centers, visibility, accessibility are great. And these are things that are important to look at in retail assets, because the tenants, because they're important to the tenants. You have to look at it as who's in this space. Are they profitable? Not profitable? If they blew out, who would we put back in there? What would that turnover process look like? So anyway, so building condition appears to be no defects. All right, put together an Argus run for you. All right, so if I sent you a financial package on something that we're looking at doing, this is actually the format that you would see. So I want to go through and explain this a little bit more. So here's the rent roll. Here's our first tenant. This is our restaurant tenant, the lease. So these labels up here correspond with the lines under the tenant. So tenant name is called restaurant because like I said, I had to generalize this. It's a retail lease, starts January 2011, goes to December 2020. It's 120 months, so it's a 10-year deal. They are taking 3,174 square feet. Here's their pro rata share. Here's their rate per year plus triple nets. Okay. This is the rate per year, so 95,000 per year, per month, per square foot, which is $2.50, and then per month. So these are the base rents. Okay. And here are the changes. So in this deal, I put together 2% escalations. Okay. And these tenants are going to have their own detailed reimbursement methods. So what does that mean? So when you have a net lease, your net lease will stipulate the different categories where the tenant will actually reimburse for common area maintenance, insurance, and property taxes. And in the real world, this is not always a straightforward reimbursement. Some tenants negotiate CAM caps. Some of those CAM caps may be only specific to controllable CAM. And so what's controllable CAM? You have to look in the lease to find that out. And you take those expense categories and select them to be reimbursed, or I would in this model, so that we can see an accurate picture of what the cash flow is going to look like on this deal. We talked about DRMs, detailed reimbursement method. Okay. So what happens when the tenant leaves? So we put together some market leasing assumptions about the market around the area. I'm sorry, about the market around the property we have under contract. All right. So you'll see here are the 4 tenants that I described in the subject property, in the case study setup, and you'll see a 5th tenant right here. So we're going to talk about this a little bit later. Total occupied square footage, 10,000 square feet. All right, so what we had found in this deal during the due diligence is, just a second, I'll show you a different slide. We found that there is an interesting situation with the CAM reimbursement.